Board, Rajiv Batra, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JP Morgan. Rajiv, hi, good morning. Great to have you on ET Now. Rajiv, as an Indian investor, how do you cope up in the times of war and tweets?
Good morning, Aisha, and thanks for having me back on the show. Yeah, pretty interesting time, and it reminds and gives deja vu of back to 90s, the world which most of the Gen Zs would have not seen, who are the latest investors into the market. So we are going back to square one. But yeah, market teaching us like risk management is also ultra important. Last year lesson looking at gold and silver was that asset diversification is important, and this year lessons market is learning that risk management is also paramount importance too.
But Rajiv, in this kind of a volatile time, when even precious metals have had their, heydays in the sun, and they too are ebbing off, the world is so uncertain. How do you manage risk? What asset classes do you bet on?
Definitely, Aisha, there is no hideouts at this juncture. It's only the relative returns you will try to get out of this market. So the idea should be go as lower as possible on the beta. Try to be in as much as possible in higher quality or in the higher yield kind of a spaces, and try to protect your capital rather than thinking or even going forward for a high teens or 20 or 25% kind of a return, because the capital saved now, and as the certainty start emerging, that saved capital will help you generate the higher return in future. So it's kind of a defense and offense strategy, which most of our Indian investors and viewers will understand, taking a cricket terminology on when you need to go on the front foot and when you need to go on a back foot. So that's what this market is trying to show and explain.
Rajiv, hi, morning, Sajid here. I know you spoke about how to safeguard your capital, but which are the sectors where you can get into at this point in time and where capital will be relatively safe?
If you look at the way market is reacting to the oil uncertainty, it's very easier to say and defend that you go into defensive sector like staples, healthcare, utilities, telecom, and safeguard your return. Partially it is true. Yeah, telecom at least can do that for you. But looking at the second order or even the prime input impact, one cannot even able to safeguard their money in names like staples or even like utilities and healthcare, because their key input costs getting a bit disturbed. So the right strategy would be, rather than taking a sectoral approach, people will need to take more a bottom-up approach, maybe more attuned towards a factor style, where even in terms of a cyclical spaces to something which is a quality that is in either private bank's name or even in some of your discretionary name, where you have a demand in elasticity, or in spaces where in past during the crisis company has not cut down your payout ratios or even your dividends, that kind of a names will be appearing as a safeguard rather than purely taking a sectoral approach. The reason is, like right now everyone is talking about first order impact, but second order impact will also come into play if this uncertainty prevail beyond March.
Is there a risk on earnings, Rajiv, for India?
It will if we move beyond 4 weeks. So if you like the recent report which we have published and looking at the 4 previous oil supply shocks since 1990, when emerging markets were alive and kicking since then if it's a 4 week of problem, then it takes 3 months for supply to normalize. If it's a almost 8 weeks or 2 months of problem, it takes 6 months to normalize. So the duration is 3 to 6 months of a normalization. And the longer the normalization is, the impact is higher on earnings. Historically, impacts appear after 2 to 3 quarters of a lag in earning growth. And taking that into account, based on the first order impact, 25% or 26% or of MSCI India is currently under trouble. And if we shave off their earning growth down from, which is in range from 10 to 12% straight to 0%, that India earning growth forecast for FY27 from 14-15% will come down to 11 to 12%. This is a primary order one. But if the secondary order clicks in, which means assuming this supply disruption goes beyond 3 months, then you will go back towards again the single-digit growth mark. So we need to get a certainty how longer this situation will prevail.
Rajiv, you spoke about banks and you did, sort of say that it should be a bottom-up approach that one should follow. I recall, towards the fag end of last year when we were chatting, you were very convinced about PSU banks being the space to actually bet on because, they did had that strong credit growth tailwind to them and were looking cheap as well. Having said that, in the last quarter, they've had their fair share of a run-up as well. Now, of course, it seems like a completely reverse picture, and then you have some of the, accidents like HDFC Bank as well. What's looking better right now if you were to take a full segment? Is it PSU banks still, or would you say private banks are looking cheaper right now?
We still continue to prefer PSU banks. Like we are overweight on all three, but if we go by the pecking order, then we will say PSU number one, followed by private banks from the strategy perspective, and then your NBFCs and other financial services overall. Now, if you take a step back and think about the inflation, last year, India's problem was battling deflation. That impacted the nominal growth of the country. Now, when inflation is making a comeback, which you can say without much being hurt, and the starting point 6.5% real GDP remain, you will start moving towards a nominal growth path of around 10.5, maybe 11% too. Taking that into account, that will also increase your size of credit growth too. And if we go by your credit to GDP growth ratio overall, it can come credit growth in cohort of around 14% or maybe 15%. Considering my PSU banks are much more aggressive, pricing power are still remaining with them, then PSU banks loan growth will still be there. And remember, if inflation problem makes a comeback, the pressure of NIM contraction because RBI can go for more cuts or can remain lower, that pressure also goes off the table. So higher nominal growth, higher credit growth, and the pressure of NIM contraction coming, all that worries start going away from the table. And as things settle, financial again becomes, you can say, the number one preferred sector for most of sell-siders or even on buy side too.
Rajiv, I know you don't speak on stock specific, but we have an event which happened with one of the leading private sector banks. How do you look at that event from a company's point of view, and how do investors look at this kind of event?
As you're aware, I'm not allowed to talk on a single stocks, but I will say in a current environment, and which we are seeing around in other neighboring Asia and emerging market country also, everyone is working on their guardrails. Guardrails not from the government perspectives or equity markets, but even from the corporate perspective too. Under various schemes and norms, we have heard Japan talking about their value up scheme, Korea on their value up program, Singapore on VUI. So the best time to talk about, you can say, governance or the guardrails for emerging markets or Asia is the current time, because the developed market investors are valuing all these things in a gold right now. Because if you start paying too much attention on all these important factors, your valuations will be very well received by the investors overall. So taking that factors into account in much more subjective term and on a broad terms, if we are ticking that particular box on governance and the shareholding, governance as well as on guardrails pattern, then I don't think so we need to worry too much longer. And India, I will say, have been prudently looking into that for years after years. And we have not seen so many such issues in the past. In fact, that issues are only going down rather than going up.
And, one of the key sectors which get impacted by the current war is also the auto sector. There is already a lot of downgrades which are coming in with respect to the kind of demand that may come down and the earnings that may come down in FY 27-28 for many of the things. What is your view on the auto sector? Do you think that they will be able to maintain the earnings growth?
Look, the discretionary spending or demand will at least need a proper 3 months of a hit to start showing up with the end product per se. So as an example, if let's assume this start going beyond 4 weeks. So in the first quarter, that is first quarter of FY27, your sectors like which are direct impacted by higher oil prices, that is your aviation, paint, glass, some consumer good, they will take the first jab or a hit over there. As it start reaching out through this mode towards end consumer and discretionary spending take the hit, it will start showing up in sectors like auto or like a discretionary sectors in the second quarter of FY27. But as I've said, this shock needs to prevail for longer. Let's suppose this shock prevail for 4 weeks, and because enough inventory is there in the first impacted sector till month of April and May, and then they don't pass it on to the end consumer, then you can say in second quarter FY27, people will be surprised and they will need to start revising their number higher.
Point taken, Rajiv. I wonder, Rajiv, how should one look at the FI's selling that has been rampant with regard to India? Is it just mega pessimism with regard to India? Is it AI? Is it currency? Is it a combination of factors? And when does that reverse? Because that will be the tipping point, right? If I can call it that.
So Harsh, I'll say it is one, an absolute return one, and another one is a relative one. If you are talking about the absolute perspective, last 2 weeks it's a carnage for across emerging market space where the sell-off is happening. And leave that, it is the sell-off is happening even in the safe haven spaces like precious metal too. But for the last 18 months, if you will see for India relative, the first problem had been growth, which slowly, steadily started getting addressed over the last 2 quarters. But now oil and stronger dollar have been the new, you can say, problem which has started appearing. Second was a higher valuation, which is no longer a big concern. If you look at today, FY27 or even FY28P reaching towards the territory of 18 and 15 kind of a cohort overall. And then the third problem was not having an enough tech exposure, which is addressing the question of AI, hyperscaler overall, which still remain. But the other 2 problems was slowly, steadily getting off, but 2 new problems emerged. Due to this one, earlier on a relative term, money was shifting within EM towards avenue, where valuations were cheaper, growth were higher, or who had a higher exposure towards tech, that is largely Korea, Taiwan, or even the commodity spaces like South Africa and Brazil. But now the problem is money is just going towards one heaven, and that is back to dollar. And hence this is the reason why we have seen the Dixie index rebounding from 96 to 100 level. Once the dust settles and people start revisiting impact of the shock to the growth, and that's where if India is still able to deliver a double-digit growth with a current set of a P that is in the zone of 16 to 17 or even 18, then the PEG ratio looks very lucrative for investors to make a comeback. But for that, we need, again, I will repeat myself, a clarity on this geopolitical tension.
So, Rajiv, to sum it up, what do you think could be the best and the worst case scenario for India right now? Should the war get prolonged in the worst case, and the best case being, this week in itself, we hear some truths?
I'll say the best case scenario would be it stopped within this 4 weeks in line with what our JP Morgan Global Geopolitical Center house view is, that it shut down between 4 to 5 weeks. And if oil price averages at around $80 per barrel for entire year, then it's a manageable situation, because your current account deficit will widen from 1% to 1.5. Inflation will move up only 80 basis points, 3.2 become 4%, and GDP growth shave off happen from 6.5% to 6. But the pressure situation, if it moves beyond and the weighted average oil basket goes to $120 per barrel for this entire year, then like GDP shave off will be close to reduced by 1.3%. Current account deficit will need to increase further by 2.4, that it can go to 3.5% kind of a territory, and CPI could go well beyond the top end of the RBI targeting regime. So that will be your bear case kind of a scenario.
And what would it translate into for a Nifty level, if at all, Rajiv? Because we've already breached 23K as of yesterday. And for the longest time, over a year now, we've been just stuck in a range.
I don't want to shock you, but looking at the previous evidences, I know history don't repeat, but it usually rhymes. The peak to trough median India decline during this oil supply shock is 22% dollarized term. And you can look at the current market from peak to trough, we are down only 11 to 12%. So if this persists, then we have to grow through the historic lens, and so that means my trough level could be below my bear case also.
Rajiv, very quickly, last question. What do you sell at this point, if at all one were a seller?
I'll still say I'll be seller into the OMCs. I'll be seller into IT space. I'll be still seller into some of the expensive like healthcare spaces, because right now when the de-risking is going on, anybody who is trading at a higher multiple, even if it's a defensive, they will get a hit, because first round of a correction is led by de-rating, and the second round usually come through by earnings downgrade.
Well, Rajiv, you did shock all of us. What you're indicating is that in the worst case, it's going to be another 12% of a fall, even from these levels. I hope it doesn't play out.
I'll just say, like, we don't need to go too far behind. Like during the COVID, remember, India declined 38% from peak to trough. But once we found the trough in month of March, India staged a rally of 82%. And one more oil shock incident, I will remind you, US invading Iraq during 2002 and 2003. India again declined almost close to 25-30% odd. But after that, everyone knows, after 2002 and 3, India staged almost a 500% kind of a rally. So if fundamentals are intact and policy remain prudent, India has a long-term potential to keep on delivering on growth.
Oh yeah, sure enough. It's part and parcel of the, the nature of the beast is such. It always plays out, and eventually it all resurrects as well. But Rajiv, great to have you on the show today. Thank you so much for your time.
Thank you.
Okay, let me just revisit. Today, of course,